Preface. Investment refers to purchasing products and services for future gains of an individual, a family unit, or an institution. Though these products and services are not purchased for immediate consumption, they have the potential to create higher future returns for the investor. There are various types of products and services available in the financial market to benefit from the capital investments. Some of the products and services that can be used as an instrument for getting personal financial returns are bank products, bonds, stocks, investment funds, annuities, educational investments, insurance, retirement plans, and so on. By adopting a wise investment strategy and by adopting a diversified investment portfolio, the returns can be maximized and the financial goals can be achieved for both long-term and short-term tenure. The short-term financial plan is adopted for short-term monetary gains, wherein the returns can be expected within a year that is attributed with low profit and low risk factors. Examples of the short-term financial plans include savings account investments, fixed deposit scheme, money market funds. On the contrary, a long-term financial plan can be adopted for long-term monetary gains, wherein the duration of the plan can extend for more than a year. Generally, the short-term assets or products are sold in the market after the maturity period, which provides good returns for the investor. However, the long-term assets or products are held in the investor's possession that can earn returns in the form of dividends, interest, as declared in the financial market. While there are various types of investments available in the market to gain profitable returns, many types of risks prevail while adapting the personal investment plan. These risks can be mitigated by availing some of the insurance coverage bonds. For example, an individual's life can be covered through life insurance coverage, a vehicle asset of an individual can be covered through an automobile insurance coverage, and a retirement plan of an individual can be covered through long-term care insurance. Further, due to the volatile nature of the financial market, it is important to understand the various types of investment plans available in the market and the kind of profitable returns that can be expected by adapting the investment plans. Some of the well-known investors who have succeeded in the financial investment market for a long time, such as Warren Buffett, Edward O. Thorpe, have attributed their success for adopting long-term investment plans with due diligence. Hence, any individual, business unit, or a family must be well versed in the money management principles to meet the financial requirements and goals for a long term. Introduction. Every individual, family, or an institution has a major responsibility of handling and managing money matters and assessing the financial requirements for both short-term and long-term goals. The science of managing individual, family or institution-related money matters that is associated with financial plans and goals is commonly referred to as personal finance. A comprehensive personal finance evaluation considers a rational decision-making factor as one of the important tools, along with other principles that can be applied on various financial-related phases that include an earning phase, a saving phase, an investing phase, and spending phase, to gain long-term profits with minimized risk. While every individual or a family unit can have different financial plans and goals, there are certain factors that enable to predict a better financial status and achieve the desired financial goal. Some of these factors are assessing the money flow at regular intervals, mitigating the risk factors by adapting certain strategies while dealing with the personal finance, choosing appropriate financial variables to reduce tax payment and enhancing the tax benefit savings, determining an investment portfolio that can address the financial needs and goals of an individual or the family unit, reducing unwanted expenses and increasing the savings for meeting the long-term financial requirements, including the retirement planning. As the factors that enable to predict and achieve the financial goals are to be understood in detail, the financial services that facilitate various types of financial activities are to be considered with equal importance to successfully carry out the financial plan and the objectives. For example, the financial services provided by the banking service facilitate various types of financial transaction on a daily basis. An individual or the family unit must be familiar in using these financial services. Further, with the usage of various financial products available in the market, such as credit cards, insurance packages, investment portfolio, the personal financial activities are to be handled or managed with more focused efforts. The following lessons discusses about the factors or the principles that directly impacts the personal financial investment plan and the mode of services that are available to implement these strategies successfully. Lesson 1. Basic information on personal financial investment. By definition, a personal finance is the science of managing monetary resources of an individual or a family, referred to as a unit, to address and meet the financial goals of the associated unit. Due to the volatile nature of the finance market, it becomes imperative for an individual to monitor and regulate the financial goals on a timely basis. Individuals must develop the finance management skills at an early age and must be capable of making rational decisions while dealing with personal finance to meet the individual financial needs and goals. The personal financial management strategy can be applied to all phases of the financial activity, including earning, saving, investing, and spending phases. An individual's or a family's financial statement and requirements can be classified under various categories for evaluating the financial stability and to predict the movement of the direction of the long-term as well as short-term financial goals. The financial management skill set consider one or more of the quantifiable categories that directly impacts the financial resources of a unit, wherein the categories include cost of education, plan to purchase assets and investments, retirement investment plans, spending habits, liabilities of a unit that includes bill payment, tax payment, and insurance payment. Each of these categories must be well planned and monitored regularly to meet the financial goals and to achieve a balance between the income earned and the expenditure incurred on a regular basis. Hence, an individual or a family needs a good knowledge on comprehensive financial planning to maintain a stable and healthy economy, and further to ascertain that the financial goals can meet the future needs. Some of the finance management skill set that an individual or a family needs to acquire are understanding the net income of the family and the expenses incurred, analyzing the financial resources and making rational decisions based on this analysis, implementing budgeting plan and setting financial goals, understanding the banking services for purchasing financial products such as credit cards, debit cards, life and home insurance, dealing with mortgages, and so on. Further, the banking services also provide basic banking-related information such as checking the saving accounts, paying the credit card bills, checking for the outstanding balance in an account, opening and closing the bonds, fixed deposits, and other bank-related transactions. Most of these finance management skills, considered as principles of the personal finance, are discussed in detail in the following lessons. Lesson 2. Decision-making process. A comprehensive financial evaluation required in assessing an individual's or a family unit's financial status is mainly dependent on rational decision-making capability due to the ever-changing economical factors and the risks associated in dealing with the monetary resources. Implementing a financial strategy that is derived based on the rational decision-making capability facilitates an individual or a family unit to optimize and demonstrate cost-effectiveness while dealing with the financial goals. Here are some of the steps that can be considered as a case scenario to make a personal investment in the form of buying an asset to gain good profits based on the rational decision. Step 1. An individual or a family unit need to clearly set the financial goals based on the monitored personal finance statement report. The personal finance statement report captures the income earned, the spending trend, the investment plan, and also the retirement plan for an individual or a family unit. Also, an individual or a family unit need to understand the current financial scenario before making a personal financial goal and the associated problems or risks that can be encountered in meeting this goal. For example, If an individual needs to buy a home or a car, the individual or the family unit needs to review the current saving and the income that flows into the account. Based on this information, the individual or the family unit can determine the options that are economically feasible to invest in such an asset. Step 2. Based on the economical feasibility factor, determine the various alternatives or options that are available for an individual or a family unit for investment purpose. For example, the balance funds available in an individual account or a family's account may be sufficient to purchase a two-wheeler or a four-wheeler and not a land property. Based on this information, an individual or a family unit can determine the type of two-wheeler or four-wheeler that can be bought based on cost optimization and risk mitigating factors. Step 3. Further, determine the ratio of the current investment made with the return value of the asset that is predicted over a period of time and the kind of services that are available for the asset. For example, a car type ABC whose value does not move downwards beyond a certain limit for the next 6 years, along with an option for an on-demand service, can be considered as the optimum asset to be purchased. Step 4. Evaluate the cost-effectiveness factor in real time for the asset that is purchased. The decision-making process is not only dependent on the monetary funds associated with the individual or the family unit, but also is dependent on other factors such as the cultural values of the family, peer recognition factor, individual habits, the emotional factor associated in making a choice, priority on family's choice, risk factors associated in making a choice, the age of the individual. For example, a family unit having school graduate children will focus mainly or give priority for the children education investment rather than giving priority on asset investment. While there are many factors to be considered while making a rational decision, the rules and styles, referred to as pointers, defining the personal finance-related activity can be tailored to derive various types of decision-making strategies. A few pointers are listed below that considers various factors for defining the decision-making strategies. Decision-making strategies. Some of the commonly used pointers to define a decision-making strategy for an individual or a family unit are listed below. Adapting impulsive or spontaneous or instant decision without giving due importance to the underlying information regarding the financial activity to be carried out by an individual or a family unit. Adapting a decision-making strategy that satisfies the family member's interest, the stakeholder's interest, or peer interest. Adapting a strategy to make a decision based on the limited options available for an individual or a family unit. Adapting a strategy to make a decision that facilitates intellectual and emotional satisfaction for an individual or a family unit. Adapting a strategy by considering only the optimized end result and ignoring the risk associated in achieving this optimized end result. Adapting a strategy by not considering the options that is expected to yield unwanted result. Adapting a strategy without giving due importance to high success and enhancing the safety and security aspects for people and the monetary resources. Adapting a strategy to derive a solution based on various facts and information to achieve finance success and satisfaction. While adapting a decision-making strategy enhances the financial success of an individual or a family unit, the macroeconomic conditions prevailing in the market can greatly affect the outcome of the financial planning. Hence, it is important to make decisions regarding the personal financial planning considering the macroeconomic conditions prevalent in the finance market. Some of the macroeconomic conditions that need to be reviewed in detail are listed below. Tracking the consumer price for determining the purchasing capability, wherein the consumer price is directly impacted due to inflation. Monitoring the consumer price based on the supply-demand ratio prevalent in the market. Tracking the GDP, gross domestic product value of the country that is determined based on the amount of goods and service produced within the country. Assessing the loan return value that includes interest rates or compound interest rates levied on the capital amount for purchasing the goods and the services. monitoring the capital inflow within the country that determines the purchasing power of the individual or the family unit, checking the share price fluctuations and the market trends recorded in the national and international stock exchanges, determining the unemployed number of persons recorded in the current market scenario. While the decision-making strategies and the macroeconomic conditions directly impacts the personal financing plan, there are certain associated risks that need to be understood in detail before adapting any of the decision-making strategies. Mainly, there are two types of risks that are prevalent while achieving the personal financial goals: the personal risk and the macroeconomic risk. Personal risk. At times, risks may be encountered due to personal reasons while implementing a financial activity, such as inconvenience caused to a person involved in a financial activity. For example, while an individual is involved in making a financial transaction by using a credit card, the credit card details can be hacked over the network. Hence, the individual credibility is at risk. Such risks must be mitigated by adapting certain risk mitigating tools and features. The other personal risk coverage required is safety and health-related coverage for a personal. For example, if a family unit is running a manufacturing business, then the family unit must monitor the working condition of the employees and provide safety assurance for the employees in the form of life insurance coverage. Another example of personal risk is an embarrassment faced by the individual or family unit while involved in a personal finance activity. A loan defaulter tag can be associated with the individual's or the family unit's account. Such embarrassing tags must be cautiously addressed, and measures must be taken to avoid such tags that can get associated with the individual or the family unit account in the future. Macroeconomic risk. Risks that are encountered due to macroeconomic changes that prevail in the finance market are inflation risk, interest rate risk, income risk, and liquidity risk. The inflation risk arises as the product prices increases and the purchasing power decreases. The personal financial planning must address the inflation risk by adapting strategies such as product diversification. For example, if a business unit has launched a product, ABC, in a mobile sector and due to the market inflation, the price of the newly launched product may increase. Due to the high capital investment contributed towards manufacturing the product ABC, the business unit may experience loss. In order to overcome such a loss, a similar product can be launched by adopting a different technology that demands considerably less capital investment. By adapting this strategy, the business unit can still make profit with the increasing inflation rate. The interest rate risk arises as the interest rate and the compound interest rate varies by affecting the purchasing power. Additionally, the interest rate variation directly impacts the saving or the investing plans and returns. The income risk arises when an individual or the family unit incurs an income loss due to various reasons, such as a career change, a job loss, and change in an income plan. As the income risk increases for an individual or the family unit, the purchasing power decreases. Hence, the personal financial planning must include plans to mitigate the futuristic income risks. The liquidity risk arises when the shares, bonds, or property investments cannot be traded easily in the finance market, and hence the individual or the family unit may encounter a huge loss in the personal financial investment without gaining immediate returns. The personal financial planning must include liquidity mitigation plans if an individual or the family unit owns such savings and investments. Generally, it is advised to opt for a diversified investment portfolio to avoid liquidity risk. Lesson 3. The budgeting process. Budgeting is a process of managing the financial expenditures and the income flow for a regular period of time. The process can be applied to any person, organization, various departments within an organization, a market, or a country to determine the savings and expenditures incurred within a specific time period. By applying the budgeting process, the income amount of varying size can be maximized in the savings and the investment plans, and also can reduce the extraneous expenditure. In general, the budgeting process is a trade-off determined between the income inflow and the expenditure incurred while dealing with the personal finance. Further, the trade-off can compute three types of budget values that include a surplus budget, a balanced budget, and a deficit budget. The surplus budget implies that the expenditure is lesser than the income inflow. The balanced budget implies that the expenditure is equal to the income inflow, and the deficit budget implies that the expenditure is greater than the income inflow. Hence, it is always advantageous to have a surplus budget to maximize the saving and the investment. While budgeting essentially provides a financial roadmap for achieving the financial goals, one of the best budgeting methods suggests opting for a 50 or 30 or 20 rule. The rule implies that 50% of the income flow will be spent on regular expenses such as living expenses, education expenses, groceries. 30% of the income flow will be spent on lifestyle expenses, shopping, entertainment, personal recreation. And 20% of the income flow can be used as saving expenses and can be used for purchasing insurance, retirement planning, and clearing the debts. In addition to understanding the budgeting method, it is advisable to understand the working of the budgeting process, wherein the budgeting process comprises of the following steps to determine the trade-off value computed for a personal finance. Step 1. An individual or a family unit need to assess the income flow and expenditures incurred based on various needs, values, and situation of life foreseen by the individual or the family unit. For example, if the income flow of a family unit A is equal to A1 plus B1 plus C1, income inflow received from various sources, and the expenditure is equal to D1 plus E1 spent on various purchases and investments, the budgeting process must check the difference between the values computed for income flow and the expenditures incurred, that is, the difference between A1 plus B1 plus C1 and D1 plus E1. Step 2. Based on the above assessment, determine a set of personal financial goals. The financial goals to be achieved must be realistic, specific, time-based, and must be supported with actionable plan. For example, a student working on a part-time basis may not be able to invest on the asset property for a couple of years. However, the student can save a part of the income every month to repay the education loan within a couple of years. The actionable plan to achieve this goal can be to save 20% of the part-time income every month until the student loan is completed. Step 3. Determine the budget for both fixed expenses and variable expenses based on the regular flow of income. Fixed expenses refer to static expenditure incurred at regular intervals, and some of the fixed expenses include paying car insurance, paying tax for the income, paying house maintenance fee. Variable expenses refer to unpredicted expenses incurred randomly, and some of the variable expenses include paying medical bills, paying grocery expenses, paying utility damage charges. Step 4. While monitoring the fixed and variable expenses incurred, consider monitoring the saving and the investment patterns for a specific period of time. Step 5. Sum up the total expenses spent, including the saving and the investment patterns for a specific period of time, and determine the budget based on the income inflow and the total expenses spent for a specific period of time. Step 6. Take precautionary measures and alter the budgeting plans based on the repeated reviews of the existing budgeting plan to maximize the saving and the investment cost. Lesson 4. Financial Services. Based on the personal financial goals derived for an individual or a family unit, understanding the high-cost financial services offered by institutions such as banks becomes imperative for the individual or the family unit to implement the financial planning. Some of the financial services that are required for personal financial planning, which are also available as online services in the market to assist the individual or the family unit, are listed below. Money Management Service. While budgeting analysis is required for better financial planning, managing the money through the use of online applications enables the individual or the family unit to receive real-time status of the income inflow and the expenses incurred. Some of these applications enable the individual or the family unit to track the cash flow, credit card payment, bill payment, insurance payment at any instant. Additionally, these applications provide real-time information about the financial data, categorizes the information, and displays a snapshot of the current financial status. Based on the information received through the online application, the individual or the family unit can make better financial planning and manage money in real time. Emergency Investment Service. Due to the volatile nature of the market, there can be job loss or there can be additional unexpected expenses incurred by the individual or the family unit. To address these unavoidable situations and unexpected expenses, a separate saving, known as the emergency fund account, must be created and maintained. Generally, 20% of the earnings must be saved in this type of account. This type of saving helps the individual or the family unit during emergency. Debts Managing Service. Generally, it is advised not to spend more than the earned income inflow. By spending more than the income inflow, an individual or a family unit can get into debts. While debts can be seen as a negative factor in the financial transaction, debts can also be utilized for constructive purpose, such as buying assets, paying liabilities, mortgaging. Debts can be availed from the banks in the form of loans or through the usage of credit cards. While availing loans, it is important for an individual or the family unit to understand about the interest rates that needs to be paid at regular intervals. Further, the credit card's usage must be managed carefully without getting into debt traps. The credit rate must be managed effectively and the credit score must be monitored regularly to reflect a healthy financial condition. The credit score is determined based on the duration of the credit usage, the payment history, and credit-to-debt ratio. It is advisable to maintain a good credit score to ensure that the credit balance is well within the income inflow of the individual or the family unit. Student Loan Managing Service. Generally, student avails graduate loans by adapting some of the loan repayment strategies. These loans are payable within a stipulated period of time, for 10 years, or for an extended period of time, within 25 years. While the interest rates are to be paid for the tenure of the loan, the student can opt to make payment for the principal amount if the interest rates are high. However, if the interest rates are low, the student can start saving the remaining income in various ways, like purchasing a house, a property, a car. Family insurance and related services. Every individual or a family unit must ensure that there are sufficient insurance coverage policies opted to meet the financial needs of the family members in case of emergency. Further, the individual or a family unit must be ready with an agreement will to transfer the assets or properties to the next kin when the owner of the asset or property is incapacitated or is critically ill. The family members or the individual must be aware of the agreement will and must be completely educated about the financial responsibilities. There are various trusted and recognized institutions that educate the individual or the family unit to opt for the insurance coverage policies based on the requirement. Further, with the help of an attorney, a will agreement for transferring the assets or the property and the trust documents can be prepared with the approval of the owner of the assets or the property. Tax breakup services. When an individual starts earning income or when a business unit is registered, the individual or the business unit should be completely aware of the tax payments, tax credits, and tax deductions applied on the earned income or the earned revenue. By carefully reviewing the tax liabilities, an individual or the business unit can plan for better savings and reduce the tax deductions to achieve a wise tax payment scheme. Investment portfolio services. An individual or a family unit must review the investment portfolio at regular intervals. For example, based on the financial market conditions, an individual or a family unit can plan to purchase shares or opt for a growth investment plan. The investment portfolio liabilities, including the insurance premium payment, must be calculated on a regular basis to avoid financial deficit expected on a long-term basis. With the help of registered financial brokerages or financial planning applications, the individual or the family unit can take appropriate decision while planning for an investment portfolio. Retirement Planning Service. Retirement from a service is one of the major milestones of an individual. In order to maintain the same quality of life post-retirement of an individual, a well-planned savings and investment strategy has to be followed by the individual during the earning period. By understanding the variables of payment earned, an individual can avoid paying high tax and reinvest the tax-exempted amount for retirement planning or in any other form of savings scheme. The retirement planning can achieve high investment returns for a long term. Hence, it is advisable to understand the variables of income payment and the underlying tax liability while planning and saving for the retirement phase. Free online personal finance classes and software. There are various free online personal finance classes available for the individuals to get a comprehensive knowledge about personal financing. Each of these online courses caters to various personal finance concepts and fundamentals. For example, the Open2 study, an Open University of Australia, offers the basic steps of investment. To know more about stocks, bonds, funds, and other investment portfolio, check the Morningstar's Investing Classroom. To know more about mitigating risks while planning for the personal investment and to maximize the saving for the retirement plan, check the edX, an online learning platform created by Harvard University and MIT. In addition to attending the free online courses, an individual or a family can opt to use free online personal finance software for availing various personal financial services. Each of these personal finance software is designed to provide various types of personal financing services, and the software is supported on multiple platforms including PC desktop, mobile applications, iOS phone or tablet. Some of the well-known personal financing software includes Buddy, software that provides budgeting, accounts tracking, and personal financial reports. Ace Money Lite, software that provides account handling services for multiple types of accounts. Microsoft Money Sunset Deluxe, software that imports online transactions offline. GNU Cash, software that focuses on accounting principles for small business units. PL Cash, software that uses spreadsheet data to read and analyze the financial data for generating personal finance reports. Financial Fade Personal Financial Planning software allows a naive personal financing individual or a family to plan for a long-term financial benefit based on the financial strategy adopted. Free Budgeting Spreadsheets, software used to monitor and control the budget of an individual or a family.